Daphne. Let's talk a little bit about why you think that these traditional havens are done.
Well, this traditional haven, I think they have been very much overvalued, and this is the time, if you look at the VIX, it has been very high. That represents that the market is dominated by fears of macro debt and systemic risk, and as a result, the market is going to ignore all relative value. It doesn't matter if value is good, as the market would exit and lock into profit and repatriate most of their funds back to their home countries or to more liquid markets such as U.S. Treasuries. As a result, we have come out with we are aware of the volatility and has advised our client to overweight cash. Cash is now double our strategic weight and looking for the moment to re-enter the market. And one of the signposts is, of course, VIX has to fall to below 30%. That would mean that the market would be able to bottom because of improving sentiment as well as conditions. Otherwise, for clients who are looking to have some equity exposure, we prefer high quality dividend stocks, as that would also provide some kind of risk cushion to our equity investors.
Okay, so we have that, but tell me something. Will things get better anytime soon? You're talking about the VIX falling below 30, and that's when it represents a buying opportunity. But what about equity markets? If they continue to fall, how far do they go down from here when you go, hang on a minute, this is it, and we're going to get a nice bounce back up again?
Okay, what we have seen is that because I focus mainly on Asian markets, and we have looked at the MSCI Asia Pacific ex-Japan as well as the MSCI emerging markets, they have clearly entered into the bear market territory since they reached the peak in late April, early May. Of course, the first trigger was inflation, which we have seen last year, followed by very stringent anti-inflation policies, which led to PE derating, and now we're entering into the second stage of the bear market, driven by this risk aversion. Is completely risk off, and as long as we don't see any clarity, on the part of recession, I think recession fear is highest for Europe, and the other issues that concern market is, of course, the European debt issues. Unless we see some clarity on resolution, the VIX is continue to be very high, and that is not very good for risk taking. And so we will be watching that sign, as well as U.S. dollar strengthening. If you look at the dollar index, it's at it's close to about 80, and only if U.S. dollar weaken will investor come back to the Asian markets.
Daphne, very quickly, we've got the European debt crisis, which is really overarching and really causing all these markets to decline. There's uncertainty, there's fear out there. If we had a default from Greece, let's say, an orderly default, would that actually help these equity markets in going up here? And that would be an irony, wouldn't it?
I think ultimately the market is still looking for some kind of resolution on that debt issue. So I believe that even a Greece default might just trigger some kind of contagion. So unless they could come out with a unified agreement on how to resolve the whole issues, market is going to react adversely. So at the moment, what market is seeing that there is a lack of political view. So unless we see that, I think the market will continue to remain very, very volatile. However, if you look at the past crisis in 2008, Europe seems to be able to be spurred into action at the last minute by the market and financial conditions, and we hope that this time they will do the same. As a result, our bank's view is that there should not be any Lehman-like meltdown.